Hi, Mark Anderson here, mortgage banker with Paramount Bank. I do lend in all 50 states, and I would love the opportunity to earn your business. For today's mortgage rate update, I'm going to keep this relatively brief, and I want to identify a pattern that has emerged. Now, any pattern that emerges in this crazy, bonkers market, any pattern that emerges can quickly be replaced by another pattern. But I think it is fair to say that for right now, the single factor that is most dominant in controlling mortgage rates day to day, the single factor that is behind the volatility that we are experiencing as far as mortgage rates day to day with all of the midday price changes, it all goes back to the Federal Reserve and their bond buying program. Now, the Federal Reserve has, when it announced this program, indicated basically daily limits. They said, we will buy a maximum of $50 billion of mortgage bonds for the day, or $40 billion, or $25 billion. They set these limits. But what has happened is that they never seem to actually buy up to the stated limit in advance. Now, I can't explain the reasons behind this. I have had a really hard time parsing what exactly the Federal Reserve is doing and what is motivating their preference. But their preference does seem pretty clear. When bond prices hit this 104 level, that's when it seems like the Federal Reserve says, you know, we've stimulated this market enough. And that's when they start turning off the tap. Now, that may explain why, in my opinion, we didn't see the proportional drop in rates that one would normally expect seeing a bond price of 104. That may explain that, because as soon as it hits that level, that generally speaking is when the Fed closes off that tap and the bond prices seem to fall into this 103 to 103.8 to 103.9 bond price level. And this is over the past 2 business days. That seems to be where the bond price is kind of leveling off at. Now, I've made the argument in the past that for all sorts of reasons, there does appear to be a technical bottom end to what you can expect interest rates to do. What is informing this bottom end, what is controlling this bottom end from a technical standpoint of interest rates is a couple things. It is not only the Federal Reserve bond buying program and their preferences for turning on the knob and turning off the knob, but it is also related to these capacity issues that I've mentioned in previous videos. You know, basically these institutional investors can only handle so much volume. They only want so much volume. And so that between these two factors, it seems that at least for right now, the bond prices are settling into this kind of 103.8 to 103.9 level. That may explain, again, why when the bond prices reached 104, we didn't see this massive push for the big institutional investors to go and drop their rates. Maybe that's because these big institutional investors know that this price level is not really going to be sustainable. The Federal Reserve is not going to keep the tap open to support sustained bond prices at that 104 level. So that may explain why they have been unwilling to really be as loose or reacting in a rate reduction pattern in the way that maybe we would normally expect at that bond price level. So what is my recommendation? Knowing that anything can change at a moment's notice, we may be seeing a kind of settling in to rates that are not at the lowest levels that we reached, but they're also not anywhere close to the highest levels that we've reached recently. I would say still, if you've got a 4 in front of your interest rate, it probably makes pretty good sense to look at locking in a refinance. Have your preferred loan officer, whether that's me or somebody else, run the numbers for you, but we seem to be settling into this level here. Now, could we hit those low points again? Absolutely. There's just no guarantees. And so as I've stated in previous videos, if you're fundamentally motivated by hitting the absolute rock bottom rate, maybe your rate right now is not, it doesn't have a 4 in front of it. Maybe you're trying to go from 3.5 to 3 or 2.875 on a 30-year fix. And that's really the drop that you need in order to be motivated to do the refinance. If that's the case, again, the best thing you can do, get with the lender, have that lender monitor your specific scenario and put you in a position to lock in when that becomes available. Just know that hitting that is tricky because the pricing that we see at 9:30 in the morning can very quickly change. Again, you want to have your full application into your lender so that, you know, if I'm the one that's doing it, if I've got the application, I can really just click that button right when that pricing gets to your target level. But just know there's really no guarantees that we're going to see that again. I think it's certainly possible. We seem to have this pattern of up and down and up and down. But for right now, pricing overall, I would characterize as very favorable. It's just not quite as low as the absolute lowest points. Well, thank you for watching. I hope you've gotten something out of watching this video. If you have any questions or if you'd like me to look at your scenario, please give me a call, send me a text, and I would love the opportunity to work with you. Thank you very much.